NVIDIA just posted $44 billion in revenue, up 69% in 1 year. Their cash flow through the roof. But here's the real question. Is it too late to buy, or is this just the beginning of something even bigger? Stick around, because we're diving deep into their latest earnings, future growth potential, and whether NVIDIA is still a smart investment in 2025, based on both fundamentals and dividend safety. NVIDIA, established in 1993, is a global technology company best known for its graphics processing units, which power gaming, artificial intelligence, data centers, and autonomous vehicles. The company generates revenue primarily from selling GPUs used in gaming consoles, PCs, and workstations, as well as from AI-focused chips used in machine learning, cloud computing, and high-performance computing applications. NVIDIA is a leader in AI innovation, with its GPUs playing a critical role in powering large language models, automated systems, and data center infrastructure. NVIDIA is currently available with a starting dividend yield of 0.03%, compared to its 5-year average of 0.06%. The price-to-earnings ratio is currently 33.2, while the 5-year average stands at 42.2 and the sector average is 27.8. The expected price range is estimated to be between $182 and $223, while the stock is currently trading around $159, suggesting it appears to be undervalued based on these figures. The company currently pays a dividend of 4 cents on a quarterly basis. The next dividend payment is scheduled for October 3rd, and shareholders who own the stock by September 12th will be eligible to receive it. However, it's likely that not many investors hold the stock primarily for its dividend. There was no dividend increase in the most recent year. The 5-year average growth rate stands at 16.3%, while the 10-year average is 14.9%. The company has been paying dividends consistently for 12 years and occasionally increases them. The earnings payout ratio has historically been above the expected 50%, but in recent years it has dropped significantly, so there's no cause for concern. The same is true for the free cash flow payout ratio. Given that, it's no surprise that both earnings per share and free cash flow per share have been growing steadily. Based on expectations for the next 12 months, this growth is not expected to slow down. On average, the company has managed to double these figures year over the past 5 years. The shares outstanding chart shows a consistent downward trend, while the total sales chart demonstrates steady year-over-year growth. Return on equity and return on invested capital are also at exceptional levels. Operating margin and free cash flow margin have been consistently around 50 to 60% for years, while the minimum expectations are approximately 16% for operating margin and around 5% for free cash flow margin. Debt is virtually negligible. The company currently holds so much free cash that management doesn't see the need for significant borrowing. Investments and developments are financed with internal cash, which continues to generate increasingly higher returns. Interest coverage is also at extraordinary levels. The company is currently available with a starting dividend yield of 0.03%. There has been no dividend increase in the past 12 months. Its credit rating is AA-, which is considered very strong. Based on this data, the company still appears to be undervalued, but slower growth may be expected in the near future compared to the past 2 years. Disclaimer: this video is for informational and educational purposes only. It does not constitute financial advice. Always do your own research before making any investment decisions, and never base a financial decision solely on the content of this video. Let's dive into NVIDIA's latest earnings report, Q1 of fiscal year 2026, and see how they're performing today, how they got here, and what the future looks like. Year over year, NVIDIA's total revenue skyrocketed by 69%, reaching $44.1 billion. The major driver? Their data center business, which grew by an astonishing 73%, all thanks to surging demand for AI computing. Hyperscalers like Microsoft, Google, and OpenAI dramatically increased token generation needs, and NVIDIA's Blackwell chips were ready. In fact, Blackwell now accounts for nearly 70% of all data center compute revenue. Gaming wasn't left behind either. Revenue from gaming rose 42% year over year, hitting $3.8 billion, a record high, driven by Blackwell adoption among gamers and creators. The RTX 5060 and 5060 Ti launches brought high-end architecture to the mainstream. Even with a $4.5 billion inventory write-down related to H20 chips restricted by export controls, net income still came in at nearly $19 billion non-GAAP. That's up 31% from a year ago. Cash flow from operations reached $27.4 billion, a 79% year-over-year increase. NVIDIA ended the quarter with over $42.5 billion in net cash. Compared to last quarter, NVIDIA's revenue grew 12%. While gross margins declined due to the H20 inventory hit, they're still healthy at over 61% non-GAAP. NVIDIA is now shipping 72,000 Blackwell GPUs per week to hyperscalers, and they're expecting even more in Q2. NVLink revenue alone exceeded $1 billion in Q1, signaling a new growth vector. Other segments like professional visualization and automotive also saw strong momentum. Automotive revenue jumped 72% year-over-year, driven by demand for next-gen self-driving and AI vehicle stacks. Looking ahead, NVIDIA expects Q2 revenue to hit around $45 billion. But note, this includes an $8 billion reduction from lost H20 revenue due to export restrictions, mostly in China. Despite that, gross margins are projected to improve to 72% non-GAAP, thanks to stronger profitability on Blackwell shipments. On the tech front, NVIDIA just launched Blackwell Ultra, a rack-scale system with 72 GPUs and 36 CPUs acting as one massive GPU. It's 1.5x faster than the previous generation and increases AI factory revenue potential by 50x. They're also rolling out their open-source inference platform, Dynamo, and new Llama-based reasoning models. These developments show NVIDIA isn't just chasing performance, they're defining the AI software ecosystem. And finally, they plan to manufacture AI supercomputers in the US for the first time, with production capacity reaching $500 billion worth of infrastructure in the coming years. So is NVIDIA still a buy? While growth may slow in the short term due to regulatory constraints, long term, their position in AI infrastructure and innovation looks stronger than ever. Thanks for watching, and if you found value in today's video, give it a thumbs up and consider subscribing for more smart, long-term investing ideas. Stay patient, stay consistent, and keep building your path to financial freedom. Until next time, take care and happy investing.